once you get in, you can never leave. Good afternoon. This is Jim Perry at Perry Capital. Here's a brief recap of the week because there's so much going on out there. First of all, the S&P 500 is up about 12% on the year. Investors are reasonably happy. Interest rates have been going sideways for 3 years, and the dollar is very stable. Corporate earnings have been outstanding, and the economy continues to grow. Yet underneath that surface, there's some very, very strong undercurrents that bear attention. I kind of feel like that wayward traveler at the Hotel California. You can check in, but you can never leave. Hotel California is a great song, and music lovers have memorized all the words. We all know them. It is a story about a traveler that enters an inescapable world. And Don Henley, one of the writers, described it as a metaphor for the American dream, at least from the lens of a rock star being in LA. The point is, once you get in, you can never leave. Kind of reminds me of QE. Once it starts, you can never stop it. Kind of like government spending. It never goes down. It only goes up. And here's where we are. The national debt is now $40 trillion. And Secretary Bessent announced yesterday that they are going to increase the repurchase of outstanding Treasury bonds from Wall Street. That is QE. Now, he said it's going to go from $2 billion to $4 billion, which seems like a big number, and it is. But remember, the Fed balance sheet is at about $7 trillion. A trillion is 1,000 billion. So increasing the repurchases by $2 billion really is a very small increase. But you wouldn't know it by the markets, right? Gold was up 12% yesterday. The dollar went down about a percentage point. Interest rates went down about 1.5 points, which is a big move in Treasury bond markets. Yet here we are back today, no real change, and the stock market's going down. So it just is also a metaphor for what's going on in the markets, really. You know, it's there's so much leverage and so much systematic trading that these sort of quant systems, AI driven, can only react on information without understanding the true meaning of them. And that's the problem. Perry Capital is positioned for a continuation of the equity rally through 26 and into 27. The reason for that is that stimulus remains very favorable. The economy is expanding and corporate America has pricing power and profit margins have never been higher. The American consumer is also in very good shape, and all the metrics with respect to consumer spending continue to expand pretty much across every metric. The downside to that is this conflict in the Middle East. Oil is up toward almost $90 a barrel again. It has not affected the global economy as some people thought it might. I think there's a lot of oil out there, and it's getting distributed, but it's a problem, and it's an uncertainty. So market does not like uncertainty, and if oil stays here or goes higher, you're going to see inflation expectations rise, and of course, interest rates will follow. I suspect inflation expectations will come down. Structurally, that is in fact true in this country, not every country. But I do think that interest rates will stay stable and not become a factor in a reversal of the rally. That's important. Many people call me and ask me about private credit all the time. It's a small amount of total outstanding debt. Speaking of which, the Treasury bond market and national debt now is at $40 trillion. That's this week, I guess it got there. And Scott Bessent, Treasury Secretary, is funding more and more of it in the T-bill market. About 22 or 23% of outstanding treasuries are in bills. That's larger than all the Treasury bonds that are maturing past the 10-year. So I think that the Treasury can buy more bonds. This repurchase agreement is a decent maneuver. It sends a message to the bond vigilantes not to short the Treasury bond. But in the grand scheme of things, like I said earlier, $1 trillion is 1,000 billion, and it's only $2 trillion, and the Fed's balance sheet is 7. So we've got room to run when that changes, and it will eventually, like trying to escape from the Hotel California. You just can't do it. The fact is the markets are in good shape until stimulus measures around the world reverse, and we're not going to see that anytime soon.